Now for this class, we're going to cover the exercises related to lab 3. For lab 3, we will be officially using R to implement the factor models. And the first factor models that we want to implement is the fundamental factor model. So we will go through the whole process. So first is about constructing factors, and then we will extract factor premium. For fundamental factor model, the factor exposure is the variable itself. So we are in a pretty good position of measuring the factor already. We don't need to estimate it. The factor exposure is the variable itself. For example, price to book ratio, price to earnings ratio. These can be the factor exposure directly observable. And then what we need to do is to estimate the factor premium. So that's our step 2. So step 1, construct factor so that we get the factor exposure. Step 2 is to estimate the factor premium. And step 3 probably will be, forming our fundamental factor model, because we have factor now, we have factor premium as well. Then we can have our estimates for expected return. All right, so we have learned the theory, but there is a distance between theory and practices. So in practice, we know the estimation, we know the steps, but when you are actually dealing with the data, there are some issues about constructing or just programming issue, technical issues that we need to solve in our R. So just a preview. We will be dealing with these couple of fundamental factors, and these are not the complete list. So we're just, having a bit of, one part of the whole factor zoo. We will be using it in our lab, but it doesn't represent the whole in universe of the factor zoos. So we will be looking at, for example, dividend yield, price to book ratio, return on equity. So each of the stocks will have their own factors. So then let's go back to our R. So if you are here, you can I guess the best way is to split your screen. So one part showing my screen sharing, another part showing your own R. So here, now we are opening lab 3, part A. So we are looking at the R script here. So the R script contains the algorithm. So what we have here has been shown in the Word document, and we will have our Word document ever for all the following labs. So the Word document will contain some little description about what data do we have, and then some description about our preparation job for doing our analysis. And then the third part will be the analysis. So the analysis will be our main task today. And then the R note here will contain some supplementary materials showing you what each of the function mean in our R. And further on will be our analysis for the homework. All right. So what do we have here for our lab exercise? So we do want to, for part A, we do want to construct factors. For part B, we will be estimating the factor premium. Now, therefore, if you want to be a quantitative analyst and you need to start everything from scratch, which means that nobody will calculate the factor for you. You can, unless you can have the factors unless you subscribe to a couple of data providers. So we have discussed some data providers that will construct the factor for you. But if you want to do, let's say, if you're running a very small hedge fund and you do want to have your own, research team to dig into the seeking alpha process. So then we have our raw data. So our raw data contains the stocks. Now we need identifiers for the stocks. You usually will not use the full company name. So usually you will have a ticker symbol. Ticker symbols are the symbols that you use to look for the stocks when you are trading for the stocks. So this is the identifier at firm level. For financial data, we have identifier for firm level. We should also have an identifier for time, and that will be the month. So this is the panel data that we are talking about. So here we have a panel data. The panel is identified by the time and also by the firm in this case. So this example, the panel is at country and year level. So in this case, each of this observation will vary by country and will also vary by year. So they are observed across time and also across entities. Now, can we have a third dimension? And the answer is yes. If we have firm here, we have year here, we can also have state. So the state will be the headquarters of the firm. So that will be a third dimension. All right, so here's the panel data. And one of the exam questions is to ask you to explain cross-sectional data and time series data. And for cross-sectional data is you fix in the year and you have a cross-sectional firms. For time series data is that you fix a country or you fix a firm and you have a time series of data. All right, so opening up our data, you'll have a better sense. So our data will be located in the text file, txt file, data lab 3. And that's a very, very typical data set for portfolio manager. So you have ticker, month, price, and these are the firm fundamentals. You don't have price to cash flow ratio. You don't have price to dividend ratio. You have only raw cash flow, raw dividend, raw EPS, raw net income, raw R&D expenses. And to construct factors, we'll need to calculate all of these by ourselves. And one data issue. So normally you need to look at your date variable and to see if they are directly usable. In this case, it's not. It's a mix of numbers and character. So you will rarely see that your computer package, software package can process this kind of variable directly, a variable that makes number and string. So you neither need to split it, or you need to convert it to a date variable, a time variable that your package can process it directly. So here, our first task is to split month into year, number, and month within the year. So we'll have to split this month variable here. That's one of the things that we need to do to prepare our data for our analysis. And then you should also notice that these are the prices. So this series shows you the price of the stocks, and this little m here shows you that's these end of the month prices. So it's at monthly frequency. And the fundamental data, they are at quarterly frequency. There's no monthly frequency for data unless you are insider of the firm. Let's say you work for Home Depot and you are the financial analyst of Home Depot, and you can definitely have your cash flow at daily level or your expenses at daily level, but that's for insiders, and they're not going to share it with others because that's related to there's no SEC regulation for that, so it's unnecessary for them to share it. All right, go back to our R script, we have finished up the introduction for data. So let's run first couple of lines here. And I have mentioned last time that remove means that you will clear up your environment. Now that, I open my RStudio just now, so there's no previous work here, but it's a good line of codes that will help you to clear up things if you do not close your R very often. Now the start time is not that necessary here. It will, but the purpose is to measure how long your program runs. And since that we're using it as in this lab, so it's just a sample of codes if you need it in the future to record your programming time. And then this is essential, sync output txt. This means that we're gonna send all the outputs to a text file. So if you run this line, usually for example, some of the output will be show in your console, right? But if you run this line, put the output into a text file, then your output wouldn't be shown in your console. It will be sent it to another text file. So if you at this point, feel free to interrupt me at any time if you want more explanation for this, or you want me to further clarify. So I do want to see whether you fully understand each of the steps. All right, so I probably will gonna run this as well. So then next was import the data. We have learned this before, so I'm just gonna skip it. So once you have run this line, you're gonna see your data is here in data. If you open it, just click the name, and you're gonna see what we saw from the text file, but in a very nice way. So you have table here. You have a table here, and I will just close it. Here, to explain this, in your text file, usually text file is different from an Excel file or CSV file. Your text file will record everything in a raw text way. So meaning that there is no rows and no columns. The only way to separate your variable is by this separator. So when reading TXT file, you do want to let your R know. If you're using Python, you do want to let your Python or MATLAB know that's what is the separator. But if this is not TXT, but CSV or Excel, then you have number of rows, number of columns already. You don't need to specify the separator anymore. I think the computer package will know how to read Excel tables. But for text file, you do need to add the separator. In this case, the TXT file, the separator is /t, but this is not always /t. It can be others like comma or semicolon. So this can be changed, and sometimes you do need to your data may not have header. So this will be false. In our case, we have header. So header equals to choose means that the first row will be the header. They will be read it as your data value. All right, so string as factors false means that we don't want to convert string variables into factors. Factors is another variable type. So we do want our variable type, we do want to read it as vectors, since vectors are the most operatable data type in R. So then we are doing this, split in our date variable. We use some strings split, and the separator will be M. So the month variable will be our the variable to be manipulated. So then we want to assign year month variable. This is a new variable. And this year month will contain the first part of month, which will be the year, and then the second part of month, which will be the within year month. So I'm going to run this. yeah, I need to run this attach. So attach, it means, I think I mentioned this in our last class. So I do want to use month, which is a variable in our in data. So this is a variable name called month. I do want to use month directly. I don't want to let my R write this data name every time I want to use the variable that contains in the data. I don't want to write it in this way just for simplicity. I want to use the attach function, letting my R knows that I'm referring to the in data file every time I call month, or every time I call any variable within in data. I don't need to specify the name of the data set when I am using my data variable. All right, so that's the function of attach. And you always want to deattach it once you finish your block here. So I'm deattaching it at the end. All right. So run this line to split it. Run the second line to split it as well. And you're going to see it here. Let me just show you text. So effectively, the variable month is split into two, but you're going to see it's a list. List is a data type in R. So it contains two columns. The first column is year, second column is month. But this month is the month number within a year, right? And here we're putting it, we are unlisted. Unlisted means that we want, so test2 is a vector. It's not a data. In test here, it's a data that contains a list of two variables here. So one variable here, one variable here. So this is a list. This is just a data type in R. All right, so test2 here is not a list, it's just a vector. So everything is recorded here. So there are 600 rows. So here, this means row number 1, and this is the row number 604946. So these are the row numbers. All right. And I cannot use test or test2. I do want to convert it into a cleaner variable type. So putting it to a matrix, putting it to a matrix here. I have year, month here. Open it up, just to see. I have put the variable into a matrix. So the variable is here. When I first split it, it's still a string variable. So that's why I want to make it into a numeric variable. So I'm adding this function as well. And then I have year, month, which is a number, and so I can put it into a matrix. All right, so I have matrix, and oh, it's gonna take time. Oh, I shouldn't open it. All right, close it. All right, so moving on to the next one, I do want to put all of my year number into a variable called year. So it's a nice and clean variable that only contains the year. And I also have my second variable, which is called month in year, which is a numerical variable that only contains month in the year. So here I'm telling my R, that's the first column, should be the first column. The first column of year, month is year. And the second column of year, month variable is month. So that's what it means here, right? So running the next two. So then I can construct a new variable called months or month number. So I'll assign month number to my panel data. So this is a very standard way of dealing with panel data, that you want to have a month number. So it will be better when you further want to merge more data into your original data. Your identifier for the date will be month number if it's monthly frequency. So you don't need to match the year, you don't need to match the month separately. So month number contains the information of the year and also contains the information of the month. And it's continuous. So meaning that's the end of the year of the end of the month of last year and the beginning, the January of this year, are in the sequence. So there's no gap between the month number. So the month number varies by 1 each month. All right. So going further, we will start to prepare our data. So here we do want to construct a couple of factors. Let me just go back to our Excel Word file. Now these are the data that we have. And we want to construct the following variables. And they are new variables. They need some calculation. And for example, we need to construct return lead, which is the price return, percentage return of the stock in month T+1. Let's say all of these variable, when they are put into the same row, when they are in the same row, they are in this year, right? And I want to take a lead of the variable so that this is T+1 and all the others are in time T. That's return lead because we want to avoid look ahead bias. Let me show you our formula. Yes, look ahead bias here. So when we're estimating panels of estimating parameters of the model using data, we cannot use future information. That's why we want to take a lead. All right. Going back to our Excel file. Next variable is called capital expenditure ratio. So capital expenditure is a factor, but it's not comparable if you use the level of capital expenditure. It's not comparable across stocks. You will have some fixed effect out there. Like big firms, large firm, they naturally have higher capital expenditure, but it does not mean that they have high capital expenditure relative to the total assets they have. So we do want to have a ratio so that it's measurable. So we scaled it. So we know that how much capital expenditure this firm spend compared to its own size. And we need to scale it by the total asset here. All right, so the same amount of capital expenditures means very differently if the firm has different size. So it may be very material or very impactful for a small firm to spend a certain amount of capital expenditure because they are small, but that number may be, not really meaningful to a big firm. So we do want to scale it. Next is debt to equity. This is a financial. This is a ratio that measuring the how the firm finance itself. So total liability over total equity. We have total liability, we have total equity. We just need to take a ratio for it. Price to book, price per share over total assets. Price to cash flow. So use cash flow as a denominator. and use dividend as a denominator, using earnings per share as a denominator. And R&D ratio, we want to scale the R&D expenses by the total asset of the firm. Return on equity is a profitability ratio showing you what's the rate of return that the equity investment can get for this firm. So it will be net income over total asset. All right, we will use the price directly to calculate return. But one thing that you need to keep in mind that when you calculate return based on price, you have to take care of dividends. So if I want to criticize our method here, so number one, criticisms will be your way of calculating return does not include dividend. But let's just ignore dividend here, because we just want to show a demonstration of how of the whole process. And the first step is to calculate a return lead variable, and then we'll work on the following variable here. Here we will be using, so implementation issue. So it sounds so simple. We're just taking the, taking this variable divided by that, but we need to be mindful that the price variable is at a monthly level, and the book cash flow, dividend, earnings show that in our data, which you can easily see that they are in quarterly frequency. So then we do need to work on it, because otherwise you will have so many missing variables there. All right. So then how are we going to work on it? You want to increase the frequency of cash flow, book value, dividend, and earnings, so that in every single month, you'll have the value for that. So in our text file, let me show you. So you want to fill all of the missing value here, the missing value here, all the way down, with the previous value of capital expenditure, cash flow, dividend, net income, so that you increase the data frequency of a quality data to a monthly data. And you don't want to use future information. So that means, let's see here, 2008 January. That's the data for this time interval. And when you move on to 2008 February, you're not going to use the data here. You're going to still use the last available data, which is 34 for the capital expenditure. So 34 here for February 2008, 34 here for March 2008 as well. And when you have a new data, a new observation updated in April, and you can update the May value for capital expenditure to 37 instead of 34, because the last available value for capital expenditure is 37. All right, so that's what we're going to do for constructing these couple of ratios. So we will use latest price in each month and accounting values that are at least 3 months old and at most 5 months old. 3 to 5 means it's 3 to 3, 4, 5. All right, so you're not using future value. You're not using future value. The future value here is month. It's a return month, and you do want to use all the accounting data that is prior to the return month, so you can mimic the information sets that is available to investors, because investors at this point they do not know the future cash flow, dividend, and earnings of the firm. So we will assume return gap of exactly 3 months. So here we will be shifting our variables here in our R. And how are we going to do that? We're gonna implement it in our R script, right? So first, we will initialize the required vectors. So initializing required vectors meaning that we will need to create some empty variables that to be filled into some observation by the observations. But at first, we just create variable name, return lead, capital expenditure ratio, debt to equity, and all of these. And we don't want to write a repeated code for creating this or initializing these factors. So that's why we have a for loop here. So to basically make our algorithm more efficient, because we basically want to assign missing value to the variable called return lead, assign missing value to the variable called capital expenditure ratio. Sounds very repetitive. So since this can be done in for loop, so we will just create a variable list called variable. So for each of the variable in the variable list, assign missing value. And the missing value will be assigned to each of the row. And how many rows are there? The rows is, we have n number of rows, n is defined by the length of month. We have a month variable. Let me just run it. So the month variable that we have previously is the month number. So how many month number that we have means that how many data rows that we'll need to create, right? So the month number, the number of rows here is roughly 300,000, which is shown here, 302473. That is the number of rows that we want to create it for each of this variable. So I'm going to do the for loop, assign. Now that I have so many new variables here, 1, 2, 3, 4, 5, 6, 7, 8, 9. I have created 9 new variable. And here, if I open each one of them, you're going to see they have they have an NA assigned it to each one of them. And the number of rows here are exactly, is exactly 300,000. So 302473 is the number of, it's the length of the month variable here. So if you click on it on your own R, my R somehow freeze here in this environment, you're going to see that you have NA for each of the row, which is exactly what we want at this point, because we haven't filling in the actual observation and values for each of the variable. We're just initializing the vector. All right, next one is, remember, we do want to match our price with previous accounting data. So meaning that we do want to create some lead and lag variables here. Then creating lead and lag variables, similar, that's what we are doing here in R, but similarly in Python, you will do a shift function. But here, I will be creating the ticker, the lead variable of ticker, the lead variable of month, the lead variable of price. All right, so I'm gonna create this 3. So how do I know this is a lead variable? I'm not using a lead function at all. So it's a lead variable because our variable will start from the second row of our original ticker. The variable called ticker, it has value from row 1 all the way to row n. But since I will be creating lead variable, so I will create a new variable called ticker shift, and then the first variable will be the second row, and the second row will be matched to the first row. So then that's why ticker shift, this variable is a lead variable. All right. Then, I will be calculating my return lead. So using price. Pricing in the second row is price at time t plus 1, right? So price at time t plus 1 divided by price at time t minus 1 is our percentage return times 100. Then we'll measure in the return in percentage. All right, so that's how we calculate return. We have return here. And but last time I mentioned in class, we are using the panel data. And if I shift, let me show it in my slides. If I shift 0.6 to this row, 0.2 to this row, 1.3 to this row, if it's within the country, it's fine. It's the real lead variable. But every time when I switch from country 1 to country 2, I'm using 1.3, shift it to another country. So 1.3 is the number for country 2 only, and it shouldn't appear in the data points that is associated with another country, which is country 1 here, when I am creating this lead variable. So then to solve this issue, so every time when I shift it, that means the first variable here should be the last variable here for each of the country should be a missing value, because 1.3 should not be the value for x1 of country 1. It only belongs to country 2. So 1.3 here should not be shifted to the upper row. So then the last observation, there's no lead value for the last observation for country 1 here, if they are sorted by time. So we'll assign missing value here for the last observation of each entity, of each country. In our case, with each firms, the last observation should be missing, should contains nothing, or we just keep or we just exclude the last observation for each firm. Excuse me. So that's what we will be doing when we are writing these 3 lines of code. We have construct return variable here. Somehow I couldn't show it, but if you are doing it in your R, try to click on return lead 0, and you probably will be able to see. So then how do I exclude the last observation of each firm, so that my return is indeed the return of each firm? I'm not using the price of another firm to calculate return. So I'll create this to be included. This will be a logical variable, so it only contains value which is true or false. So I will run this line, run this line, run this line. All right, I accidentally run all of the line, but that's fine. So here, all right, here, what it mean? What it mean by running these by writing it in this way? So to be included means that if in our data our lead variable of ticker equals to the real ticker, equals to the ticker, so meaning that when we are shifting, let's say country, we are creating a lead variable for country. So here we are using we're putting, let me see if I can write it in my pen. Great. So I'm creating a lead variable. So this is 1, 1, 2. Because I'm shifting this up, shifting this up, shifting this up. So this is also 2, 2, and here will be 3, 3, 3, and missing, because this is the last observation. There's no more observation here, nothing to be shift here. All right, so then we need to exclude this one, exclude this one, and also exclude this one, because you know, there's no lead variable for the last observation of this country. So we don't want to use another country's variable to construct our measure. All right, in our R, if ticker equals to ticker shift, meaning that if this country 1 equals to country 1, country 1 equals to country 1, country 1 does not equals to country 1, it equals to country 2. So this will be false, false, true, true. This is true, true, false, true, true. Here, 3 comparing to the missing value. So, and this will be also a false for the last one. All right, we will have a new logical, the vector only contains logical argument, which is true or false. So this is a new variable, new vector, T, T, F, T, T, F, T, T, F. All right, it kind of flag the last observation for us. It flags the last observation for each country. It flags the observation here. So for the observation that we want, the value is true. For the observation that we don't want, the value is F. That is this line. And we also need to verify it. If month equals to month shift minus 1, same here. This is 2001. 2001. Here is 2002. This is 2000. So we want here, we're using year, so it's similar. So if year equals to year plus 1, then we want to keep it. So then this is true, true, false. Right, so 2002 does not equals to 2000 plus 1. Then this is false, right? So we have a felm identifier confirmed it, time identifier confirmed it, so that we can effectively flag the observations that we don't want. Flag the observation here, flag the observation here. Then when we're calculating our final return lead variable, we only want to include those that has flag in our variable. All right, so to be only to be included is true, then will be included in our new return lead variable here. So we in this case, our return lead comparing to return lead 0 will the difference will be that the last observation of each country, of each felm, will set to a missing value in return lead. Right, so that's then complete for constructing our return variable. Then then how about other variable here, right? So other variables we need to increase the quarterly frequency to monthly, right? Convert quarterly variable into monthly variable. So we will be doing the same thing. So here we are taking the lead. For these variable, we are taking the lag. And we will be taking the lag for 3 times. So you know, the most recent quarterly observation has the lag equals to 3, the number of months in between, and the and cover the whole quarter. So the maximum gap will be 5 number of months between the return month and your accounting variables month. So this is a for loop because we'll be doing the same similar things for generating the lag variable. The difference is how many number of months that we want in between. So this will be defined by n minus gap. So n minus gap means this if it's gap equals to 3, then it will be number of rows minus 3. If gap equals to 5, then that will be number of rows, which is this 302473 minus 5. So then we'll shift everything upward, or we'll shift everything downward. So when we're taking the lead, we are shifting everything upward. So we are excluding the first row here. So then when we are matching this with the data that we have, the second row becomes the first row. And here, the first row becomes the second row. Okay, so that's what we want here. Then we will start to apply this for all the variable that will be needed. Ticker, month, capital expenditure, total assets, total liability, R&D expenses, all the variable in our data. So creates the lag variable. And then we'll start to calculate the factor. So we want capital expenditure ratio, which will be capital expenditure shift divided by total assets shift. That's the capital expenditure ratio. And we do want to make sure using this mechanism, making sure that since we're taking the lag, so we will make sure that the first variable is set to be a missing value. Since we'll be creating a lag variable, so we are shifting this here, we are shifting this here. So 1.3 is here, 7.8 is here, 1.1, 1.1, 4.1, 5.0, very ugly handwriting, 7.2, 6.4, 6.4. Okay. Then what are the values that are not correct, not belongs to the same country? So 1.3 is still the country's lag observation of X3. 7.8 is also the one that belongs to country 1. But does country 2 has X3 equals to 1.1 in its previous period? And the answer is no. So this does not belong to country 2. So we do want to cross it. we do not need, it's very dangerous to use 1.1 and make it and calculate a variable based on 1.1 for country 2, because 1.1 is not a value for country 2. Not it's the effect when we are taking a lag variable, it shift down, but it's not belongs to country 2. So we do not want to include it. So same here for 7.2 here. This is not belongs to country 3. And there's no value for the first observation of this lag variable for x3. This is x3 lag. So then we want to set this as false. So ticker equals to ticker shift. Month equals to month shift plus gap, which means that your month here, this month, should equals to your previous month plus 1 if you're just shifting it by 1. So then this is false, true, true, false, true. All right, and then and so on and so forth, so that we can flag this term and also flag this observation, flag this observation, and they won't be included in our lag variable. And this is lag by 1. Same here, this is lag by 2. This is lag by 1. If we want to lag by 2, lag by 3, we are just changing the gap here. If you're lagging by 1 month, the gap equals to 1, and it is shown here. The effect is shown here. If it's lag by 2, then your observation here should be missing. Your observation here should be also missing. That's the effect when you are lagging it by 2, right? And we are using a loop to effectively taking care, incorporating all of this so that we don't write everything repeatedly. All right, so these 3 lines will help us exclude the first observation, the first couple of observations, depending on how many lag that you want to take, which does not belong to that specific country or that specific firm, will help us to exclude that. And then the capital expenditure ratio comparing to capital expenditure ratio 0, the difference is that our capital expenditure ratio includes only the values that is true here. So includes only the observation that is belongs to its own firm. And we are not using other firms' value to calculate capital expenditure ratio due to the lag effect in our data. All right, so then we have to add this, we have to add these 3 lines to each of our construction for the factor, right? Because each of them faces the questions when we lag them. So second variable debt to equity, we are effectively using the debt divided by the equity. Equity will be total assets minus total liability, that's equity. So so we'll also need to do that, exclude the first couple of observation that belongs to the previous firm, not this firm. And same here when we are doing R&D expenses, formula is here, but we need to adjust for the lag effect. So using R&D, previous R&D, so R&D shift means we're using the last available R&D, most available R&D in the past divided by total asset shift as well. So same here for price to book, price to cash flow, price to dividend. So I do have some blanks here. for calculating net income over assets, I do want you to put the equation similar to this in the line of here. Put the formula for calculating price to earnings ratio, put it here. All right, similar to this one. So I'll give some time for you to do that, and I'll show you my code in 2 or 3 minutes. Right, showing you the code that I wrote for net income. So I do want you to write the formula for calculating net income over total asset here. Very, very simple. Just copy down the formula for calculating R&D and change R&D into net income. So I have net income shift divided by total asset shift here. That will be the formula I want to put for calculating net income over total assets. That will be our ROE. So and how do I know? How do I know the formula? So go back to your Word file. Formula is here. For ROE, the definition is net income over total assets. So the formula are the construction of each of the variable, of each of the factor is described that in your Word document here. So then next is, I believe, will be price earnings ratio. So price earnings ratio should be something similar here. So copy it down here. And let me just check price earnings ratio here. We do want price over earnings per share. So we want price over earnings per share. Now, price is the current price. Earnings per share is the earnings per share in the previous, from the previous quarter or from the last available quarter, right? Any questions so far? Well, I can monitor the chat if you put questions on chat. Okay, great. So let me just show you what variable do we have so far. We have already successfully, if you ran this couple of lines and correctly input the formula for ROE and also for price earnings, then the massive loop function here will be ran, and we will not only increase the quarterly frequency into monthly, but also be able to construct the factors that we want. And let me just show you. Let's see, capital expenditure ratio. We find capital expenditure ratio 1, capital expenditure ratio 2. It has a lot of missing value here because we don't have values for the first couple of observations. So these are NA regardless, because we don't have accounting data for 2007 for ticker A. Let's scroll it down to see. I should be able to find Apple pretty soon. Oops, it's not loading Apple. All right, fine. I will show you the ticker. Probably will be better. Here is ticker shift. Our original ticker is in the data. So the first observation is A, showing you the firm identifier, A all the way. And my ticker shift has assigned its missing value for the first 5, because my last return gap, my last month gap is 5. So I'm running from gap 3 to gap 5. So it stopped at gap equals to 5. So then that's why my first 5 observation for ticker shift are NA. And here 8 starts from number 6. And then this basically shifts 8 here to the 6th row. All right. And shift here the 2nd row to the 7th, 3rd to the 8th. So 8 minus 3 equals to 5. So that means we are exactly taking 5 lag for our lag variable. All right. And for R&D ratio and R&D ratio 0, the difference is we assigned missing value for the first 5 observations. for R&D because the first 5 observations are the observations from the previous firm. So we don't want to use previous firm's R&D to calculate our firm's R&D ratio. So we have prepared at this point. We have prepared all the variable we want. Then it's time to select, to screen our factors. Not all the factors are needed. We only want to, we need to do some screening for the factors. So the screening that we're going to do is using univariate regression. So we'll run univariate regression here for each of the variable that we created: price book, price cash flow, capital expenditure, R&D, ROE. And the regression function in R is LM. LM means, okay, it means here. LM means running simple OLS regression. And the Y variable is the variable before this little curly symbol, return lead. And our X variable is here, price to book. And effectively, you only need this to run this regression, right? To detach it. But we need to print out our output for this regression. So that's why we need to add summary. So summary, and I believe you'll be able to output the results by only by just using this summary function. Let me see if that works. So now you're not seeing anything because we ran this line, but at the very beginning we are sending all of the output to a text file. So that's why when we are running regression, we don't see the regression results in our console. So you need to go back to your folder. My folder is here. So the folder of your working directory, there you will be able to see an output txt file. It has been it was just being modified. All right, great. It contains the regression output of return over price to book ratio. I have only ran this line, so I have only one regression output in this text file. So it's the return as a y variable. The x variable is price to book. So I do want to see, by running this regression, I do want to see the factor, which is price to book, is able to predict future return. Return lead is a future return. Price to book, we are constructing it all using historical information. All right. So here is the estimate for beta. Here's the estimate for alpha, the intercept. We're not so curious about alpha, we're curious about beta to see whether this price to book is significant or not. Gladly, it is. So T value is very big, the absolute value of T, very big. P value, very small. So our error is reduced to minimum. So this variable price to book is significant, good news. Okay, and then we'll do it for the rest of the factor. So just run it all the way down. When I run this sync bracket, it means that I will have my output directed to console again. So I'm just ending my relationship with the text file, which is under my working directory. So I'm breaking this link between my text file and my output. So now if I run this line, let's see this line. and refresh it and open it up. All right, good. So it has all of the information in my text file. So it contains the regression for price to book. And the second one is price to dividend, price to earnings, capital expenditure. So we do want to have some analysis now because we have ran the regression. We have obtained it, the factor premium. So beta is a factor and F is a factor premium. So we have the factor premium here already. Now that we do want to ask ourselves, what do we learn from it? We want to learn, is each of these factors significant? Can you explain the sign of the coefficient? We have our, if you read the appendix in our textbook, appendix in chapter 4, appendix 1, or appendix A, we have some prior to each of this variable. So this is the value. So price to book, we know that value firms outperform growth firms on average, but we cannot say if with a small sample period, the result is consistent with what we found from our longer sample period. So we do want to compare the coefficient that we obtained here, and we want to interpret it. So then we want to also spot out the most significant factor here. And if we want to choose 3 factors, which one would you like to choose? I will start from the most significant one, right? So let's just do a screening. All right, for price to book, let me just split my screen. And oh, I did this one. Okay, good. For price to book, significant. All right, significant. And very significant. Significant at 1% confidence level. So we only have 1% chance of rejecting a wrong hypothesis, right? So 1% of making mistake. So that's pretty acceptable. And then second one, price to dividend, which is here. Also significant. Price to dividend, significant. Going down, price to earnings, significant, and these are all negative, which is good because price to book, price to dividend, price to similar things. Price to earnings, price to dividend, significant, price to earnings, significant, price to cash flow, significant, and negative. So which means that if the firms has higher price to book, price to earnings, price to cash flow, price to dividend, it will have lower future return. So growth stocks underperform value stocks in the future, which is consistent with our previous knowledge towards value firms versus growth. So that's good, a good thing. And then going down, I want to see capital expenditure ratio, insignificant. Debt to equity ratio, insignificant. R&D, insignificant. And ROE, insignificant. So I do not mark any one of them. Not significant, not significant, not significant, not significant. All right, so Then out of all the 8 variable here, which variable is most significant? So then I need to, so there are 2 significance out there I've discussed in the class. One is statistical significant, another one is economic significance. We haven't standardized our data, so we cannot compare each of these coefficient by just looking at the magnitude, because they themselves have different magnitudes. If we do not scale this by some degree, so then we can compare it across different coefficient. If we cannot do that if we do not do standardization. Standardization is here. This is standardization. You have your raw variable minus the mean of that variable divided by the standard deviation of that variable, so that we demean it. We also scaled it by the standard deviation. In this way, every firm will have a mean. So not every firm, every variable will have a mean equals to 0, standard deviation equals to 1. So the coefficient that we estimate from our regression can, we can use the coefficient to compare to another coefficient, because the raw variable, the raw exposure has been standardized. So we can do the comparison of economic significance across factors. We haven't done that. So the only thing that we can compare is the statistical significance, which is the t-value. Now, which factor has the highest t-value? That is price to book. It has a t-value equals to -4. By saying highest, I mean the absolute value. So equals to 4. 3 also is high. So that is, let me just mark it here. Price to book has highest. Reddit. And this one is price to cash flow. Second significant. Second most significant. And then I have price to earnings, and then price to dividend. Right, price to earnings is the next one. And then price to dividend. All right, so that will answer question number 9. If I want to choose 3 factors, which one should I choose? Is it necessary to run multiple regression? In this case, in general, it's necessary to put all of the factors together. But since the factors that are significant are all somehow measure the same dimension, which is the value versus growth dimension, that firm characteristics. So in this case, I think it's not that necessary to put price to book, price to cash flow, and price to earnings together into one regression, because they are kind of capturing the same thing. But if somehow you found R&D ratio debt to equity significant, then it will be necessary to put R&D debt and price to book, or price to cash flow into the same regression. These 3 variables are looking at the very similar things. They're just changing their denominator using another accounting measurement of profitability. All right, so that is probably all that we want to cover in lab 3 part A. And I'll leave a question for you. Select the 3 most significant factors from single variable regression and run a regression of returns on these 3 variables and discuss the joint significance of these variables. Yes, I have discussed that. We don't need to put all of these three into one regression. But I do want you to know how to run multivariate regression. So just run a multivariate regression on the 3 variables here, 1, 2, and 3, and to see what you found. So univariate regression, they all have a negative coefficient. And we know that they are somehow correlated. So you will observe some issue when we are putting it into one regression, because one substitute another, and that will make the coefficient really weird. But I do want you to understand how to write a code for a multivariate regression. It's pretty simple, and you're going to see that in our part B exercises. So I'll leave this part to you. That's for the first question in homework 3. All right, now that we'll move on to part B. So I close it. So in part B, we have another data set. And will be incorporated. So in our part B, we have all of these factors prepared already, so we don't need to repeat our steps. So each of them, we have, this definition of each of these factors match exactly what we have done in part A. So I can skip this part. Here, we will do some data manipulation on the variables that we constructed, on the factors that we constructed, because we know that some factor has issue if we just use the raw material, if we just use the raw factor exposure. The ones that needs our extension is market cap, price to book, and also these. So we have these are the factor: market cap, price to book, price to cash flow, price to dividend, price to earnings. And there's an issue of using them directly. And the issue is some of the, like the cap, market cap, we have some large firm with really outrageous number of market share in this market. And we have plenty of small firms. So our variable for market cap is very, very unstable, or we have the issue of outliers, and we want to take care of those large firms, but we don't want them to bias our result for running the regression. So going back to the slides, this relates to one of our attempts to address the issue of outliers. We have a problem of outliers with the market cap. So if we use market cap directly to extract factor premium, and we see that it do not work, it does not mean that there's no relation. It may be, maybe we need to do some more, we need to fix the issue that we have for market cap first before we run any regression. And the issue is outliers. Okay, so those outliers are not errors, so we cannot exclude them. Exclude them means that we're probably gonna exclude Apple, Amazon, Google. But then how do we incorporate them while also not affecting our regression result? So raw market cap does not make sense economically. So then when we are putting this here, the outlier is gonna lay here, and these are very impactful firms. We don't want to exclude them. So the way of dealing with it is to take a log. So once we take a log on the market cap, so basically take the log value of market cap, we still have those big firms, but they lies in here. So they lies in here. We don't have that many number of firms that with huge number of market cap. And now that we smooth out, now that we are able to smooth out our variable for market cap, so that it makes sense to see a much more, bell shape better distribution of market cap now. So most of the firm now has a median that is here. So median market cap is here. And this bar represents the number of firms or the frequency of the variable. So more firm. So the higher the bar means that we have more firms that has some market cap that allocated in this interval. So more firms, and that makes sense because you know, this is the median, meaning that we have more firms that has a median market cap. And then we have you know, a couple of large firms that with very large market value, and they are not the raw market value, they are the log market cap. And some firms that are very small, they also have a low frequency here. So much better distribution of market cap by just taking the log. We stabilize our market cap variable. So we correct the positive skewness. Before we have positive skewness, skewness is driven by this part. All right, taking log is our solution. So going back, we will take the log for market cap. And we also take the log for price to cash flow, price to earnings, and to reduce the influence of extreme values. So in our main analysis, I do not take log value of market cap. I leave that part to homework. Okay, so in homework, I do ask you to take the log of size. All right, and that's one variable that we want to make some adjustment to. Another one is to construct momentum. Now, momentum is defined here. So 6-month price momentum, which will be the sum of price return for the past 6 months. So I have return in month 1, I have return in month 2, all the way to month 6. So my momentum factor for month 7 will be the sum of return for month 1 all the way to month 6. So I sum the 6 values, 6 different return in the past 6 months and put it to the 7 month as the momentum factor to that specific stocks. All right, so we're going to do it in the R. So open your R script for lab 3, part B here. So I think I can skip this one, right? We have talked about it. Remove means that we'll clear out the environment. And sync means that we send output. And then we also do the same thing for splitting the month. And then we'll shift. Now that here, starting from here, we start to construct our momentum factor. So I do want to use the past 6-month return data. So so that's why I have 6 here. And each of the row for return lead shift include the past 6 months. So then my momentum will be the sum of the return lead shift. I sum all the past 6 month return. So I have 6 different returns in the past 6 months because each month has 1 return. And then I take the sum of all the return for the past 6 months. So I put it into this variable called momentum. And again, I have this issue that I need to clear out the missing. I need to, exclude those return shift, those returns that belongs to the previous firm, not belongs to the firms that I want to calculate my momentum for. So I set missing value to them, to the first 6 elements, to the first 6 observation of that firm. So the first 6 observations of each firm should be empty for the variable of momentum. All right, so running these couple of lines in your R, okay. So I have my momentum here. First couple of observation is set to missing value. And then if I am, can I show the 6? No, I can't. So it should be, starting from the 7th observation of this first firm, you will have the value for momentum. All right, so then next is to take the log. Well, next one is pretty easy. Take the log of price to cash flow ratio, price to earnings. So you use the log function in R. Then I will do my regression. But I would, there are some missing value for momentum. There are some missing value for price to cash flow, price to earnings. So I do want to exclude missing value by using complete function. So I put them, but these are the variable that I prepare for the regression. I only include them into a new data called reg data. I put them into reg data. So I have reg data here. This is a data frame. Data frame is a data type in R. And similarly in Python, you also have data frame as a data type. So if you open it, reg data, you're going to see it only includes the variables that you will be using in your regression in the return, which is a future return. This is a date variable. Effectively, you can see that your momentum starts here. All right. Sorry. Your momentum starts here, the 7th. Here, you are taking the sum of the previous 6 return. The previous 6 return is these 6 numbers, 1, 2, 3, 4, 5, 6. And then you put it here to the 7th. So that's momentum. All right, going back. So I still have 5 minutes, but we're there, almost there. So here is the data for running the regression. And I simply exclude all the missing variable here. So previously when I show you reg data, still have missing variable. No, so now that I want to clear out, so detach it. All right, so now that if I open it, it should not contain any of the missing value, okay? Then we can start to do some regression. Now here's a way of doing multivariate regression. So you can, refer to the code here to solve the first question in your homework. So you just use plus to put more x variable on the right-hand side. And the data equals to reg data that we just prepared for the regression. So then I want to introduce a couple of different ways of running the regression. So this is always an issue when you have panel data. So when we have panel data, if you run a pool OLS regression, your regression will treat y variable as a one series, and x variable as another time series. So it wouldn't recognize that these. It's discard. So it wouldn't recognize that there are multiple countries here. So it will treat all of them as one country. So when you're running your regression, so your y variable is here, x variable is these 3. If you run a pool OLS, you're just running the whole series of this variable on the whole series of this variable. And that has issue because there is a fixed effect for one single country and for one particular year. So what if in year 2001 for each of the country, they suffer from the dot-com bubble. So there is a fixed effect for 2001 only that applies to all of the country, but there's no such effect on 2002 anymore. And also, what if there is some domestically shortage of labor in country one, but there's no shortage of labor in country two? So that creates a fixed effect among different countries. So I will just show you the fixed effect here, the heterogeneity across country. So here is the average across country. All right, so they are not the same. We can see that there is country fixed effect here. There is significant difference between this level and this level, and they are two different countries. So here, heterogeneity across year, we also see that significantly higher value for my Y variable in 1997 and significantly lower in 1990. So I do want to address it using not using a poor OLS. My poor OLS will tell me that X variable is insignificant. I do want to control for the fixed effect, at time fixed effect and also firm fixed effect. So I'm adding the dummy variable for my firm and the dummy variable for the year. All right, so that's my fixed effect model. So I'm effectively adding a dummy variable for indicator variable for each of the country, A, B, C, D, E, all the way to G. And now that after controlling for explanatory variable sets at country level, my X1 is now able to explain Y significantly. So previously, when you run OLS regression, your regression has biased results because there is almost unobserved variable that vary your Y at country level. And now I control that. So I put country on the right-hand side. So each country's fixed effect is controlled. So I can have a relatively pure relationship between Y and X1. So X1 is now able to explain Y. All right, so we'll do it in our R. First, this is the pool OLS. There's no fixed effect at all. If you want to add fixed effects, incorporate the month here, and month will be automatically expanded into dummy. If you are not that sure, you can also add factor. That will help your R to figure out that this is actually a fixed effect. Or you can run this FELM, fixed effects ordinary square, and put this. So then you will be effectively adding time fixed effects. Your results, these two results should be exactly the same. And if you also want to add firm fixed effects, so then just telling your R that we are including month fixed effect as well as firm fixed effects using the firm's identifier, which is ticker. All right, so if you if you have not incorporated the package, you should incorporate the package. Do I have it here? Okay, let me just first run it to see if I have it. So run it. Okay, I do not have it. So you probably need to incorporate this package. Let me just show you the package name. All right, so the package name is here. Install package. Yes. Here. In console, yes. And load the library. And then you should be able to run your the felm. All right, so the rest is to analyze. Oh, sorry. The rest is to, in your Word file, the rest is to analyze the estimates with time fixed effect, with firm fixed effect. And your homework will be just repeating all we have from our lab by changing the variable to log size, momentum, log price to book ratio based on two different models. One is the model with time fixed effect, another one is time plus firm fixed effect. Compare the estimates, and that will complete the homework. You do have some short answer questions, which does not require you to code, but that will help you understand what we have from our analysis a little bit better by just showing your explanation, by just have you to think more about the meaning of the number and estimates that we get from the regression. All right, so shoot me an email if you have any questions when you're working on homework 3, and I will be here for my office hour next week as well, next Thursday. Otherwise, have a good weekend, and I'll see you next Thursday.
Thank you, Professor.
Thank you.
Thank you.